Hey audience, this is James Kandasamy from Achieve Investment Group. Today we have another awesome educational webinar series, which we always do. We try to do on a monthly basis now. So if you are joining for the first time, make sure you subscribe to our email list or any newsletter. Just come to our website, Achieve Investment Group, and sign up to any email list. And today we're going to be talking about what passive investors need to know before filing 2022 taxes and a lot of other tax benefits that you need to know as part of being a real estate investor. So just to let everyone knows who we are. So we are deal sponsors focusing in Austin and San Antonio, Texas. We own like almost 0.5 billion in assets under management. We used to have 400,000 units. Right now we have almost 2,000 units, 19 apartments. We have raised almost $80 million. We have also 1,000 units in Class A luxury ground up development with 300 plus units under construction right now. We are vertically integrated in terms of asset management, construction, and property management. I'm also author of the two best-selling book, Passive Investing in Commercial Real Estate and Smarter Doctors, which is specifically for doctors who are investing in real estate syndication. And you can join us in our Facebook group as well. Our Facebook group is called Multifamily Investors Group. So without delay, I'm gonna pass the baton to Amanda Han and Matt McFarlane. Let me make sure I make them hosts. So while they show their video and their slide. Hey, hi. Can you say something, Amanda and Matt, so that I can make sure I can hear you?
Yes.
Okay,
You
great.
can hear us okay? Awesome.
Yeah, we can hear you very well. So Amanda and Matt McFarlane are CPAs and tax strategists who specialize in helping people use real estate to save massive amount of taxes and keep their hard-earned money. I mean, I used to listen to Amanda in Bigger Pockets when I started about 10 years ago, right? So, and both of them bring a wealth of knowledge. So they're also authors of highly rated book, Tax Strategy for Savvy Real Estate Investors, and they've been featured on many publications, including Forbes, Money Magazine, Talks at Google, CNBC Smart Money, as well as the Bigger Pocket podcast. They have helped 1,000 of investors nationwide to save on taxes. So I'm going to pass the baton to Amanda and Matt. In case I've missed out something about your credibility, please let the audience know, and you can start presenting your slides.
Yeah, well, thank you, James. Appreciate it. Thanks for having us. Give us a second. We're just finishing up the technical stuff here. This is what happens when you have accountants trying to run technology. But yeah, we're going to kind of touch on some stuff about what to expect during tax season. I know a lot of questions come up about different tax strategies and different things to kind of be aware of, especially as we're in the heart of tax season. So we've got a few different topics to kind of go over. I'm going to kind of run through everything. We got about 30 minutes. So let's just jump right in.
Yeah, you guys can see our presentation slide. Okay, just put it in the chat box.
Yeah, I think they have to use the Q&A box. Yes, they can see it. Yes.
Okay. Awesome.
Okay, cool.
Okay, so yeah, I think James already did a great introduction for us. So let's go ahead and get started. Mainly today we want to cover. I know most of you guys here are passive investors in real estate. In working with James, some of you probably also have real estate of your own. But today we really want to focus kind of on the passive investment side of things. But to kick us off, why are we here, right? What the reason right now is tax season. And what's really interesting is what a lot of people might not know is that one of the silent killers of our wealth building is actually taxes. So you might hear people talk about, we spend more money in taxes than we do on food and clothing and housing and all of that combined. All those might be hard to believe. Here's kind of a little bit behind the numbers on what creates that reality.
Yeah, so right now our highest federal income tax rate is 37%. Those of us lucky to live in the great state of California, our highest income tax rate is 13%. Now, not every state obviously has that, but there's other highest taxing states like New York and a few other ones out there. If you have your own business, work for yourself, you're looking at payroll taxes of 15%. Real estate investors, we all know that when you sell real estate, you're paying capital gains taxes. That can be up to 24%. And then also, if you happen to pass away without a good estate tax plan in place, you could be looking at estate taxes upwards close to 40%. So you can kind of see numbers wise why being proactive about saving taxes and cutting back on one of your big expenses is very, very important.
Yes, and I know for you guys to be joining us instead of having dinner with your family and friends, it means you already think taxes is important and you care about it. So here's another graphical a pie chart we put together. So if the numbers on the previous slide doesn't make as much sense, here's what you can see. Someone who makes about $500,000, and this we did it for a single person, before tax to see all that money. After taxes, you end up with about $199,000 if you're looking at federal, state, payroll, investment taxes. So again,
kind of eye-opening, isn't it? It's
yes.
like seeing it in that kind of format really brings it to the forefront, obviously.
Yeah.
Yes.
Not only that, in my book called Smarter Doctors, I have a tax table which shows compounding effect of $1 over 25 years. And if you don't have taxes, the $1 becomes like 3 point something million, versus if you have taxes, it becomes like 75,000.
That's what we call, that's what we call the tax drag, right? Like,
yeah.
Yeah. And that's the benefit of real estate investing, which we're going to talk about in just a moment. But one of the latest and greatest too, in addition to just having a high tax rate, is the IRS had over $80 billion of additional funding. Lucky for all of us, more than half of that, you can see here, 45 billion of that is currently earmarked for IRS audits. Okay, so it's really important for us to know that this is kind of coming down the funnel. Now, it doesn't mean that we should stop using tax strategies and just kind of run away and not write anything off. It simply means that we need to do a better job at planning to make sure we have ways to reduce our taxes. And so we want to start with kind of some tips to protect yourself, again, specifically with respect to being passive syndication investors coming up on April 15th. Here are some of the things that we want to be doing.
So first and foremost, obviously, is kind of make sure you're gathering your tax documents. This is very important, is that, we recommend our clients to kind of obviously work on this throughout the year, but, we all know life gets in the way sometimes. So, but it's important as you're getting ready to get your taxes prepared, you definitely need to have your documents in place, because without having good documentation, you're going to miss out on things. You're going to miss deductions that you forgot about. If you do get audited, remember, you're going to get audited not 3 weeks after you file your return. It's going to be 2 to 3 years after you file it. So you want to make sure you have your documents in place that you don't have to go back 3 years from now and try and find something from the 2022 tax season, right?
Yeah, and even if you have documents that you think do not have a tax impact, still send it to your tax preparer, because you just never know. Specifically with respect to syndications, I know some of you might have invested in syndications through your retirement accounts like IRAs or 401ks. Although odds are you're not paying taxes on that money, still send it to your tax person. Again, just to be safe, right? You don't want that to be the reason or the issue where something comes up on an audit.
Again, for those of you investing, a lot of you listening today are investing in passive syndications. Very important that you get your K1 recipient information in place. So, we help with syndication tax returns all the time, and never fails to amaze us that, after you're done preparing a return, getting it all done, you get these emails that, hey, this partner's information is incorrect. Well, that's the kind of stuff that you as the investor should be helping the syndicator make sure the stuff's right. Are you investing with your personal name? Are you investing with an entity name? Is the EIN or social security number you're providing correct? The type of taxpayer, is it a partnership? Is it a single member LLC? Is it personal? All that kind of stuff is very vital to making sure your K1 is prepared correctly.
Yes, and if you received K1s already from your syndication investments, make sure you review that beforehand. Even though you might be on extension until October, but take a look at it now. Sometimes it's a little bit too late later on to make those change. Communication with tax preparer, obviously this is a huge one, right? Whenever you are making investments, whether it's your own properties or buying a business or investing in a real estate syndication, make sure you let your tax advisor know, preferably beforehand when you do that, because then they can kind of help guide you. For example, where's the best source of money to make that investment? Is it with your cash? Is it with some HELOC money that you just borrowed against? Is it with your retirement account? All those have different impacts when it comes to taxes. And of course, if you invested in a property or a syndication that has sold, you really want to be on top of that and make sure you communicate that with your tax preparer, because then they can help you identify ways to reduce the taxes on that gain or looking at offset strategies.
Along the same lines, if you guys created new entities during the year, make sure you're communicating that with your tax preparer as well and have all that documentation in place. Did you create a new partnership? Did you create an S Corp, a C Corp, a single member LLC? What state was it formed in? Does it need to file its own tax return this year? These are all the things you kind of need to get in place and have those conversations beforehand so that we make sure that nothing is missed, because what you don't want to get is a letter 6 to 12 months down the road saying, where's the tax return for this? And you said, oops, I forgot, and then, it could lead to issues down the road, obviously.
Yes. I mean, ideally, you talk to your tax person before you formed entities, right? But if you didn't, now is a good time to make sure you talk to them about that for extensions and all that stuff. Ownership changes, that's another one we see quite a bit. Again, whether it's directly owned real estate, but we see that more so when it comes to syndication investments, where maybe you invested in this particular syndication last year was using your personal name, but this year, because of tax or liability protection reasons, you formed an LLC to then hold that investment. So two people you want to inform, right? One is the syndicator, because they're the ones issuing the K1. You want to make sure the K1 now has your LLC name or your trust name, so that you're able to have that be reflected correctly. And the second person to inform, of course, is your tax preparer, so they know where to record that accordingly on the particular tax return. Okay, so as you have questions, feel free to type it into the Q&A box, and we'll try to get to them as we can. I know we have a fairly sophisticated audience here, so obviously with respect to your own real estate properties, you can maximize your write-offs, like your home office, your car expenses, travel cost, all those things, right? But again, today we're focusing more on syndication investments. And one of the biggest benefits of real estate investing in general is the whole concept of depreciation, right?
Right. We kind of call, we refer to depreciation like the ninth wonder of the world. It's one of our favorite. I do, maybe. But it's one of those great things in the tax world where it's kind of the incentive, basically the government's going to let you write off the purchase price of part of your property, even if it's going up in value, appreciating in value. The IRS looks at it in the way that, hey, well, normal wear and tear, it's going down in value, so we're going to let you write it off kind of through like what we call paper expense, right? So you're getting to write off a portion of your purchase price of your rental real estate over the years to offset that cash flow, so that we're reducing taxable income.
Yeah, for residential properties, usually 27.5 years will you write it off. For commercial real estate, it's 39 years. A big misconception for investors, apartments, even though they are commercial real estate for loan purposes, it is considered residential for tax. So that's good, because the depreciation life is 27.5 years. Now that's the baseline for taking depreciation, but for most syndication investments, larger properties, even a lot of our clients with small single family homes, you can use accelerated depreciation, otherwise known as cost segregation, to really push up your tax benefit to earlier years, rather than having to wait 27.5 years to claim those tax benefits. And like Matt said, the depreciation is allowable regardless of whether the property increases in value or decreases in value. And it's also true regardless of whether you have an investment all cash or you're using debt or leverage. So let's go over an example of what that means on a smaller scale.
Yeah, so think about it is, if you had $100,000 to invest, you have a couple options, right? You could buy $100,000 property all cash. And in a situation like that, maybe normal depreciation, maybe do a little accelerated depreciation. Maybe you'll get, based on experience, maybe $20,000 in depreciation expense that first year if you did some sort of accelerated depreciation. Not bad. Obviously, that's good. But the other option to look at, if you have $100,000 to invest, you could use that $100,000 as a down payment on maybe a $500,000 property. So now we're using the bank's money, right? We're using leverage. And in that example, you could, not uncommon to see $125,000 of depreciation expense in that first year. Now, again, think about that. You've put $100,000 into the property, but the depreciation write-off alone could be slightly more than the money that you actually put in, right? So that's that's kind of the power of using leverage from a tax planning, tax deduction standpoint.
Yes, and so this is an example where like you invested, or your down payment was 100,000, but your depreciation is the same or more than the investment now. And we're going to go over kind of the K1 form in just a moment. A lot of you probably just received that or will be receiving it shortly. Before we get to that, Sam had a question. You said the county land value is 80%, which is way off. Can I use other methods? So for depreciation, we only depreciate building and the components of the building, not the land. And hence, this is Sam's question, like, hey, the county is saying the land is so expensive, I'm not getting as much benefit. There are a couple different ways to allocate land. The most common is obviously county records, but you can also look at appraisals. So typically when you purchase rental properties, you have an appraisal report. Appraisal is another good one. I've seen cost segregation companies use comp analysis. So looking at comps around the area to get to better land versus building. But yeah, a couple of those, as long as it's a method that's substantiated, typically by someone who has a license in that area, those should be fine. All right, so let's take a look at a K1. Again, most of you probably either have received it already or are going to be receiving a K1 from your passive investment syndications. So we wanted to go through some FAQs that we get because we have, for our firm, we have clients who are syndicators and we have clients who are the passive investors. So you kind of see both sides of the coin. But here's the actual form itself. The three areas that we've highlighted are the key areas that you want, that you'll probably be seeing. The dark blue one is information about the partner.
Yeah, so as we were talking about earlier, making sure you have the partner and the recipient information correct. And this is the area we're going to see it on, kind of lines E and F and G and H and all that kind of stuff, is basically making sure that, if you invest with your personal name, that this doesn't say ABC LLC and it says your personal name or your social security number instead of an EIN and that kind of thing. So you're making sure that this is, because this is what's getting reported to the IRS. You want to make sure it's correct, obviously.
Yeah, so this is the part where, if you received a K1, the draft K1, but this information is wrong, right? Like, oh, they have my personal name, but I actually invested with my LLC, then make sure you go back and try to request for this to be corrected sooner rather than later. Okay?
Yeah, and a lot of times too, remember, you might get that communication from the sponsor that says, here's the tax returns are done, here's your K, you can download your K1. Please review and respond back within, whatever, 7 days, if there's any issues with your name and all that stuff. That's the time that you would definitely want to take and look at this, talk to your CPA about it, help out the sponsor and the syndicator, keep things moving on a timely basis, because they are going to file the returns, obviously, if they don't hear back from investors with any potential changes, right?
Yes, so don't sit on that until October. All right, and then the light blue area, this is what line 2, net rental income and loss. This is, for most of you, this is where you'll see the biggest dollar amount. So this represents your share of the tax loss or tax income from this particular investment. We're going to cover that a little bit later in terms of frequently asked questions.
Right, and keep in mind, this is different than line 19 where we highlighted in yellow distribution. So if you get a distribution of $10,000 during the year, that doesn't mean that line 2 net rental real estate is going to say $10,000 on it. It could show a loss, it could show something different. So the actual amount that you pay income taxes on, which generally is line 2 for those of you investing in rental syndications, may or may not correlate directly with the distribution line.
Yeah. Okay. So those are, again, the kind of the main areas that you typically see. But let's go over some FAQs. One of the most common ones we get is, why do I have a large loss? We sometimes see investors sort of panic and say, oh my gosh, I invested $100,000. I see an $80,000 loss. This is really bad. Money has been lost.
I'm screwed. My money's gone.
Yes, and that's typically not the reason why you see a loss, right? Earlier, we talked about depreciation, accelerated depreciation that you can use for your own rental properties, but you can also use this on syndications, and syndications are typically larger properties, apartments, mobile home parks, self-storage. So the losses often are pretty large. So again, just because you see a large tax loss on your K1 does not automatically mean that money has been lost. For the most part, it typically means these are the tax benefits that have been extrapolated from the investment that you made. Okay.
Through the depreciation, right, and the cost segregation that we're talking about.
Yep.
Okay, another one, just alluding to it, how are distributions taxed, right? So people get this check during the year, they get a $30,000 check, and they're assuming that I'm going to have to pay taxes on that $30,000. And that's probably very unlikely based on, especially early on in a syndication. It's not uncommon to see that you're getting distributions first couple of years, but you're getting those tax losses online too because of the cost segregation. So distributions from a partnership generally by themselves are not taxed. There are times when they can be, but most likely scenarios are not going to be.
Yeah. Yep. And that's a common misconception we see all the time. All right. So next question, probably another frequently asked one. How do K1 losses impact me as a passive investor? The answer to this question will depend on your personal situation. I think from a high level perspective, if you are a real estate professional with respect to your own properties, we'll talk about that in just a moment, then it is possible that these K1 losses are also ordinary losses or non-passive, which can offset different types of income. On the other hand, if you or your spouse are not a real estate professional, then typically the K1 losses from the syndications are passive losses to you, which just means that they can offset taxes from other passive income or passive capital gains that you might have. If you don't have any, or if you don't have a lot of those, then your passive losses from the syndications do carry forward indefinitely to offset future passive income. Okay.
Another question we get a lot is, can I file my return without receiving my K1? You can. I guess the better question would be, should you? And generally the answer is going to be no. You should definitely wait till you get your K1s, because even though maybe the sponsor has estimated what your numbers are going to be, not uncommon to see the final numbers be different, and sometimes can be materially different. So you want to definitely, the recommendation is to wait till you get your K1.
Yes. Yep. And another one, do I have to file in different state tax returns? This one will depend on what states you are getting K1s from, whether that K1 shows profit or loss, and what other activities you might have in these different specific states. So it is really important, again, don't just send the federal K1 to your CPA, send all of the pages. Even though it might seem kind of redundant for you, we've seen K1 packages that by themselves are 20, 30 pages. Send your tax person all the pages so they can help you analyze which states you may or may not need to file taxes in.
You're being nice there. Some of those K1 packages are much
like
more,
50 pages. Yeah.
100,
Don't ask me how I
150
know.
pages.
But don't ask me how I know. Okay. Retirement accounts, we touched on this a little bit earlier, right? That retirement accounts don't have to always just be stuck in the stock market. Stock market has not done super well recently. So we have a lot of clients that are looking to move the 401k and IRA or Roth IRA money into real estate. Syndication investments is a great opportunity to use retirement money for real estate investments and real estate assets. So definitely something to think about. If you're thinking about, I want to get into real estate, I want to do more syndication investments, don't just look at available cash, but also look at the funds in your retirement account as well, because that's a source of funding that could be growing tax deferred or even tax free in real estate assets.
And for those of you with coming up on looking at filing tax returns, that they're just to let you know, there could be a lot of different options for you to still put money into retirement accounts for last year. Depends on how what activities you have going on, what type of business you have, where your type of income you're earning. But that would be definitely something to talk to your tax preparer CPA about, is what options are available to you before you file your tax returns.
Yes. All right. Real estate professional status. We touched on this a little bit earlier. Real estate professional really applies more to people who have their own rental properties as well. So, I mean, this is a topic we can probably talk about for 8 hours or more. They do have these classes even for CPAs on what is a real estate professional. But 3 main points. To be a real estate professional, it means that you spend more time in real estate than your jobs. Okay. You have to have at least 750 hours in real estate, and you have to meet material participation hours with respect to your own rental properties. A couple different ways to meet that, but the most common one is at least 500 hours in rental real estate activities. Now you might be thinking, why do I care, right? Who cares about real estate professional? The significance of real estate professional is, especially if you're someone who is a high income earner, right? If you're in the medical field, you're in a consultant. For high income earners, you can use rental losses to offset W2 and other income if you or your spouse can claim to be a real estate professional. So that's the reason earlier we said, if I get a K1 that shows a loss, how does that impact me? One of the determining factors is whether you or your spouse personally qualify as real estate professional. If you do, you meet material participation, all these different requirements, then the benefit is that your syndication losses may be eligible to offset your W-2 and other income for tax purposes as well. I think we had a question. So that was HP's question, right? How to limit, how do I use it to offset W-2 liability? We had a question, so let me move this up from someone, Balaji, that says, you had a profit on sale of primary home. Can you use syndication losses to offset that? So the answer is that will depend on real estate professional status, right? If you're a real estate professional, odds are you can use it. If not, then those are passive losses.
So let's take a quick look at, we put together a quick example of, so you can kind of see some numbers. And I believe this is actually based on one of our client situations from a couple of years ago. So, just kind of see the tax savings in action. So we're looking at a situation where couple was making $350,000 W-2 income, obviously good earning good money. They had gone out and invested in a couple properties, earned some rental income, about $32,000. So, all in there, they got income on the books about $382,000 that they're going to pay taxes on. Did some income shifting where they hired some kids and family members, not a lot, but paid $2,000, took a deduction for that. Did some deductions for car and home office. Again, nothing crazy. They're not going out and buying a new Tesla, although you can do that, I guess, if you're using it for business. But and then the big one for them is that they did depreciate. They did a cost segregation study on their couple rental properties, and then that first year they were able to accelerate almost $200,000 in depreciation expense.
Yeah, and this couple, so in that year, because they were claiming real estate professional status, or the spouse was, they also invested about $50,000 in syndication, in one syndication deal, and that K1 loss was about $38,000. So that loss was, they were able to use it to offset their total income. So all in all, their income was close to $400,000, but total income ended up being about $133,000. That was a reduction of over $248,000, and that ended up being about $100,000 in taxes saved. Right?
I mean, that's a down payment, right? I mean, on a good property where we talked earlier, right? You can use $100,000 to buy $500,000 more real estate. So
yeah, so really powerful stuff. But one thing to keep in mind, and this is probably one of the most common mistakes made by investors, is thinking that tax return filing is the same as tax planning. And those are two completely different things. The example story that we talked about, it happened by design, right? The clients were very intentional about what they did, what they invested in, tracked their hours, accelerated the depreciation, made the right syndication investments to create those tax savings. It just didn't happen by chance. And so, right now you're getting ready to meet maybe with your tax person to file 2022 taxes. That's fine, right? It's fine to go ahead and do that. But that's not really helping you with planning for 2023. And it's the planning that really is what's going to help you with tax savings going forward, especially with IRS funding being so much higher now with audits. You just want to make sure you have all the right things in place. And so if a lot of what we're talking about today is new to you, because we had limited time this evening, so we kind of went through everything really quickly. What you can do is you can go to our website at keystonecpa.com, and we have a QR code here you could just scan into your phone. To download, we have a tax savings toolkit that has a lot more detail about these and more strategies. And we have a tax opportunity finder too, which is really helpful for people who are kind of wondering, like, am I overpaying in taxes? It's a really great assessment tool to kind of help you with that.
Okay, so we have a couple minutes left. I want to see if we can power through as many of these questions as we've got.
Let's do some Q&A.
Awesome. So let's see. Devon says California does not conform to bonus depreciation. That's right. How does it get reported in the tax return? So it's exactly the same. Your CPA is going to be able to know how to report it. Basically, California, you start with federal return and you make an adjustment to back out of that bonus depreciation to get to California tax.
So if your federal return shows that rental property for federal shows a big loss because you took a lot of depreciation, California return is going to show less of a loss or possibly even income on that property, depending on the numbers.
Yes. Julian's question is, okay, paying my son, do I just write them a check, or do they need to be a W-2 or 1099? So for paying kids, it depends on what they're going to be doing. If it's a one-off project and your kids are older, you might get away with issuing 1099s. But if they're younger, or if this is going to be a recurring thing that they're doing, they act more as an employee, then you typically want to have them as W-2 employees.
All right, Sam has a question about depreciation recap. So if I take 100 grand depreciation on a property and then sell it, requiring is usually depreciation recapture. So let's say you buy for 500, you take 100 grand of depreciation, your basis is now 400, you sell it for the same 500. You, in your head, I didn't make any money, but you do have that $100,000 of recapture. But in your question, if you have a separate capital loss carryover coming from somewhere else in your return, then yeah, those would offset each other. You'd be totally fine on that.
All right, we have two questions. I think this is about whether this is passive income. So investing in gold, those are typically investment income, so not passive income like rentals. And the other one is IRA withdrawal. So if you're taking a 1099-R distribution from retirement account, those are also not considered passive income. Okay, so you can
ordinary income tax or marginal tax rates.
Yeah, so you can only use the rental losses to offset those two if you are claiming real estate professional status.
There's a question about on the K1s, can the investor in the K1 or syndication be a trust? And the answer is yes, it can be a trust, just different types of trust, but yeah, that's definitely possible. See, Will says, I have $100,000 self-managed IRA. I want to use it in real estate for passive income. Is that possible? Yes, it is possible.
Of course, yeah. That's, you simply move it from where it is into a self-directed account. Once in the self-directed account, you can use it to invest in real estate. All right, Sam has a question about short-term rental loophole. Sam, we don't have that in our presentation today. That's a topic that probably can go on for 8 hours as well. But be sure to download our tax savings toolkit. We have a whole section specifically on the short-term rental loophole, the 100-hour requirement, and all that good stuff.
So let's do one more question, and we should be good.
Okay.
On time.
All right. Should we find a really good one? There's so many. So yeah, we'll have to come back, for another one of these live sessions.
Yes.
Let's see. So this is a good one. I mean, I think it's a good one that probably applies to a lot of people. Is I have rental properties under my personal. This is from Kathy. I have rental properties under my personal name, not an LLC, not an entity name. Am I allowed to claim, let's say just deductions in general, right? Just car, home office, anything else? And Kathy, the answer is yes. So in order to take tax deductions, this is a very common misconception. You're not required to have an entity in any stretch of the imagination. You just need to have a business, and owning rental real estate, operating some business, that is a business. And so if you can, if you own them in your personal name, you can take tax deductions. If you own them in an LLC, may still end up on your personal tax return anyway. So you definitely don't need to have an entity to take tax deductions.
Yep. Well, thank you so much, I think, for coming and presenting to our audience, Amanda and Matt. We really appreciate it. There's so much information, I know, but we are short on time. I think we will try to maybe do another round, or get these questions and do it offline. But thanks so much, and we want to be respectful of everybody's time as well, including our audience. And this will be recorded, and we'll share it offline. It'll be on our YouTube channel and podcast, and we'll convert it into a podcast format as well and share it to our podcast audience. Thank you so much for coming in. Thank you.
Thanks, James. Appreciate it.
Thanks,
Thanks, everybody.
See you next
Thank you.
time.
Bye.
Everyone, bye.
Bye.